So, Mike, how long have you been in the finance industry in general?
So finance, a little over 35 years. In this business, about 24 years, which is working with real estate investors. So a long time.
Okay. So I'm 34. So you've been in finance longer than I've been alive.
Yes. Yeah.
So
Unfortunately, yes.
looking into all your experience, which I think in this industry is the best you get, like the closest thing to like a crystal ball, right? Look into that crystal ball, plus all the trends that you're keeping up to date with, the research that you do on a daily basis. Where do you see rates headed for 2024?
Well, rates will be better than they were for 2023. We've already seen that dip. October was a high, and that's what everyone predicted was a high, and we're in December now. So we see 2023, and we're going to go over some stats too, because it's always good to see stats from the Fannie Mae and NAR and the Mortgage Brokers Association, all those, because we want to see what they look at too. That's kind of like the research. It's not just a crystal ball, but it's what have I seen before? Like I've been through some downturns, and what does that mean to real estate investors? So that's what we wanted to go through not only today, knowing that October was our high, but what does that mean for 2024 for real estate investors?
Excellent. Okay, well, let's get started. What are some things to look for in 2024 then?
Well, we're going to see a more stable, like we said, market. Let's look and see what some of the experts say. Like Fannie Mae thinks rates, as far as conventional rates, the rates that people who are buying these properties from flippers or when they're refinancing you have rental property and they're using conventional, what does that look like? Fannie Mae thinks it'll be between 7 and 7.6 about, where NAR, which is the National Association of Realtors, and then the mortgage brokers, they're more in between the 6 and 7, so they're a little more optimistic. But we've already seen it. We already seen it that October was the height. And now the Fed is saying, like, we think inflation is in control and we're going to stop raising rates. But that doesn't always mean it reflects one-to-one in our world either. Because in an investor's world, there's multiple kinds of loans and they're all affected by a little bit different economic conditions. So we're just going to go through that real quick. The other thing is rates will be better, but they're going to be volatile. There's going to be months where they're up, months where they're down, depending on economic information, depending on wars in the world, all these different things that happen out there, and on an election year. So we're going to see some pretty decent rates, and I think decent rates will be in the 5s on conventional, but they'll probably be hovering in that 6 to 7%, where this year they topped out over 8.
Yeah. When do you see them getting back down to that? Down to the 5 or 6? When in 2024?
Well, first of all, it's in the conventional rates. It's really tied to the 10-year Treasury. And the 10-year Treasury, even though it's not, the Fed drops their Fed funds rate, they've raised it. Now they're looking at dropping it starting in May. That's the prediction. In May, they'll start dropping it. But it's not, like I said, one-to-one. Mortgage rates are more tied to what they call a 10-year Treasury. And the 10-year Treasury has another factor that's out there working against it. And that is the government seems to want to be spending more and more money. So they create a deficit. To create a deficit and to pay for it, they have to issue more bonds. And as they issue more and more bonds, investors want a better rate. So that ties more into like our conventional rates. So as the deficit keeps increasing, even though the Fed funds may be dropping, we may not see as big a drop in the 30-year mortgages and stuff like that. We may see more drops in like the ARMs, the 3, the 5, the 7-year ARMs that may go down a lot more. Like right now, they're very similar. There's like a quarter of a point difference between a 5-year ARM and a 30-year fixed. I think next year we're going to see a bigger spread, and it might be something that investors look for, and even homeowners look for adjustables over fixed rates.
Okay, so you're saying that you don't think that the 30-year traditional mortgages will be affected as much as the other loans?
I think they've said that a lot of this has already been built into the market, that they've already understood the Fed's going to drop stuff. So they're already pricing it in. So next year, like I said, it'll go down some. It'll stay in the 6s. It's a lot better than it was this year. But even just what's happened over the last 3 or 4 weeks, rates were around 8%. Now they've gone down 75 basis points. So as an example here, I have an example what that means to people. Like if a $300,000 loan and rates were up to 7.5%. Now they go down to 6.75. What that means on a $300,000 mortgage is if I'm selling a property, someone who could afford a $300,000 house can now afford like a $323,500. The buying power has gone up as the rates go down, which is great for flippers. But it's also good for an investor who wants a rental property, because that same $300,000 loan with that drop has increased their cash flow probably around a little over $150 a month. So every time it drops, it helps our real estate market because the lower the rates, affordability, the more people can spend and buy. There's still built up demand out there for property. So if we could keep rates in that 6 and maybe dip into the 5s on conventional, I think it'll be a good 2024.
Excellent. All right. Well, what else are we looking at in 2024?
Well, the other things, like what the Fed funds is doing does not affect Fannie, Freddie, like conventional that much, but it does affect bank loans. And a lot of investors go to banks and they get rental loans or fix and flip loans. So as the Fed drops their Fed funds rate, that will affect prime, which the banks lend off a lot in the Fed funds. So you'll see a lot more effect on investors working with banks as it drops, because there are predictions out there anywhere from 75 basis points down to 200 basis points, like 2 points, that the Fed may drop next year. We don't know. And that's why part of what we're talking about today too is we have a weekly mortgage report that goes out and says, hey, here's where DSCR rates are and here's where they're trending and all that stuff. Because we've talked about volatility, you have to keep up, because a quarter of a point here, half a point there will make a big difference when you're trying to sell something. So we want to make sure everyone's informed weekly, not just annually.
Gotcha. And at a basis point, the same thing as a percentage point?
In every percentage, so like if you're talking about 1%, there's 100 basis points. So 100 basis points equal 1%. So when you talk about 50 basis points, that's a half a point. And you'll hear that a lot in the economic world and stuff. They'll say rates went up 40 basis points or bonds. So when they say 40, it's like 40% of 1 point.
Gotcha. So it's a percentage point of a percentage point.
Exactly.
Which is hard to say. So basis points.
Yep.
Makes sense.
And also we'll keep an eye on DSCR, because DSCR is a huge factor, and so is private mortgage loans. What's going to impact those? Just today, we just saw across the board on a couple of our DSCR lenders that we go through, they dropped rates a quarter of a point. We're starting to see where rates are getting back into the 7s instead of 8s. We anticipate, because DSCR is based a lot, at least a lot of the investors, it's not like conventional where they all base it on the same thing, but they base it, a lot of them, on the 5-year or some other bonds out there. So we're going to see maybe even more drop in DSCR, which is great for investors. So every quarter of a point means more cash flow for you, means you can qualify for more property. It's just going to open up the real estate investing world again as rates keep dropping. And that's why I think it's important to keep up weekly on these kind of things and what we can do to help investors just make more money.
Yeah.
By making sure they get the best rates out there.
Gotcha. So you were saying make sure to also take a look at in 2024, keep an eye on those DSCR rates, private mortgage rates.
Yeah, you're talking about conventional rates, because conventional rates are the ones that people you're selling flips to are buying. A lot of people use for rental loans. DSCR, what your local banks are doing, and what private lending loans are out there. What's impact is this going to have on them? Because a couple years ago, private rates were in the 7s and 8s. Now they're in the 11s to 13s, just depends. So they've gone up a lot. That's affected a lot by prime. Prime is affected by what the Fed changes, which is that Fed funds rate. So as they drop that, you should start seeing the cost of private money loans on your flips, on your BRRRRs, also come down. So we'll see it come down and then just kind of stay there. 2025, they predict to be a little bit better, but 2024 will be a lot better than 2023.
Okay, awesome. 2024 is going to be way better than 2023, and we're looking at 2025 being even better.
That's what the predictions are.
Right, yeah. Those are the predictions.
We don't know, there's always something that's thrown in there. There's something that happens in the world, or, like COVID, when that hit, that changed a lot of stuff. Or
yeah.
Some kind of election or war, oil prices. We have to watch all those things. That's why we just say the weekly thing is important, or even monthly. Just keep up, know where they're going, because if you're going to be a real estate investor, you need to know where finance is going, not only for you, but for your potential buyers.
That makes sense. You've mentioned prime a couple times. Can you reiterate what that is for me?
So prime, typically it's the Wall Street Journal prime rate. That's what banks determine a lot of their lending off of.
Uh-huh.
So they take the Fed funds. The Fed funds is what the Fed is controlling. And that's what banks can borrow from the Fed or other banks from. And then what the banks do, like Fed funds right now is 5.25 to 5.5. The banks usually add 3 points to that, somewhere between 2 and 3, depending on the bank. That's what they'll lend out on, their short term, maybe their 1 or 2 year bridge loans. So that's their base lending number.
Okay.
Some of their real estate, they may be more on prime minus 1 or 2, based more on the Fed funds. So Prime is what banks use to judge a lot of what they do on credit cards, car loans, all that kind of stuff. And that's where their center when they start lending is prime. And it's mostly banks. A lot of the private money lenders borrow money from either banks or other institutions. And a lot of their money is based on one of those two factors, to either the Fed funds or prime. And they add to that. That's their margin, that's their profit when they lend it out to someone else.
So prime and the Fed funds are sort of the basis of determining what a rate's going to be.
For banks.
For banks.
Yep. So conventional was like a 10-year treasury.
Mhm.
That's what they base it off of. Usually you take the 10-year treasury and you add somewhere between 2 and 3%, and that's what mortgage rates are. So if you looked up, Googled and said, what's the 10-year treasury?
Maybe the 10-year treasury rate.
10-year treasury.
On average over 10 years.
It's like a bond. So it changes. It's just like a stock.
Gotcha.
Like you could go in the morning and it's at, the rate is 4.02, and in the afternoon it's 4.10. I mean, it fluctuates because it just depends on if there's enough money buying bonds, the government will lower the rate because they don't want to pay. But when there's not enough buyers, they have to raise the rate to attract more buyers. And then that impacts conventional rates because that's what conventional rates right now are based off of.
Well, what else are we looking at in 2024? Is there anything else rate-wise?
I think, rate-wise, as I said, it's going to help. It's going to help, especially in the spring, get rid of some of this inventory that people are sitting on. It's going to be more affordable for people to hit and buy certain, price points. As rates decrease, I think you're just going to see more volume. There's still millions of people out there without homes, but it's affordability. They got to get into not only affording it, but qualifying for it. And that's what all this is going to be. We've seen over the last 6 to 8 months, tons of people reach out to us, hundreds of people reach out to us and try to price out DSCR, and the rates are 8s and maybe sometimes even 9s. And they just don't work for the property. They're not cash flowing. Now what we're going to see is more cash flowing properties so people could pick up more properties that actually bring them money. So as rates go down, it's going to open up more opportunities for creating that wealth, creating that income.
All right. So although the market predicts rates are going to be better, they're still going to be volatile, right?
Yep.
So where can people go to, stay up to date and make sure that they're tracking where the market is?
And that's why we came up with this weekly mortgage report. It's going to go over some economic data, but it's also going to say, hey, who has the best DSCR rate? What are the rates right now for conventional rates? So you know what they are, so you're not overpaying for them. We have this report that's going to go out every week. It's going to be emailed out, or you could go to our website. So it's either at thecashflowcompany.com or just reach out to us at info@thecashflowcompany.com, and we'll make sure it gets out to you every week. And it'll just be something simple like, hey, rates are going up, rates are going down. If you want to see the specific rates, check here. And for certain people, they want to know what's the rates for their particular situation, for their credit, for their properties and all that stuff. And we actually go in and put together a report just for them because everyone's credit's a little bit different, income, properties, property sizes, all that stuff. So we have the general mortgage report, and then we have a personal one that monitors it for someone's portfolio or when they're buying it.
Excellent. And where can people go to find that?
Either just go to thecashflowcompany.com. It'll be there out on a weekly, or we could just email it out. So go to info@thecashflowcompany.com and we'll get it out to you. Probably it goes out every either Monday night or Tuesday morning.
Fantastic. Well, always good talking with you,
Yeah,
Mike.
great. Thank you,
Well,
Mike.
yeah.